Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about F5 Inc. quarterly report. F5 Inc. offers a wide range of businesses and services that cater to the needs of large enterprise businesses, public sector institutions, governments, and service providers. The company's distributed cloud services enable customers to deploy, secure, and operate applications in any architecture. The list of services provided by F5 Inc. includes unified security solutions, networking solutions, application management solutions, web app and API protection, multi-cloud networking application delivery and deployment domain name system, DNS, content delivery network, CDN, application deployment and orchestration. In addition to these services, F5 Inc. also provides a range of application security and delivery products, such as NGINX Plus, NGINX One Console, and BIG-IP systems. The company offers professional services including maintenance, consulting, training, and technical support services through various indirect channel partners, such as distributors, value-added resellers, managed service providers, systems integrators, and other partners. F5 Inc. also has partnerships with public cloud providers like Amazon Web Services, Microsoft Azure, and Google Cloud Platform. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause an F5 Inc. stock price drop. The stock price of any publicly traded company can fluctuate due to various market and economic factors. One possible reason for a decline in F5 Inc.'s stock price is poor financial performance, such as declining revenue or earnings per share. This could be due to increased competition from other companies offering similar products or services, or a failure to innovate and adapt to changing market conditions. Another potential cause of a stock price drop is negative news or announcements about the company. This could include layoffs, product recalls, or regulatory issues that raise concerns among investors. Additionally, changes in industry trends or shifts in consumer behavior can also impact a company's stock price if it fails to adapt and adjust its business strategy accordingly. Furthermore, external market factors such as economic downturns, interest rate changes, or global events can also contribute to a decline in F5 Inc.'s stock price. These factors can affect investor confidence and lead to a sell-off of shares, causing the stock price to drop. In conclusion, a decline in F5 Inc.'s stock price could be attributed to a combination of internal and external factors, including poor financial performance, negative news or announcements, changes in industry trends, and external market conditions. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted a company's financial performance. On the positive side, products revenue has grown by 11.6%, while services revenue has increased by 3.7%. Additionally, total systems revenue has seen a significant increase of 36.7% due to rising customer demand. On the other hand, software revenue has declined by 8.2%, with perpetual software sales also experiencing a decrease. The APAC region has seen a decline of 1.4%, while Customer B has experienced a net revenue decline of 1.3%. These factors have contributed to the overall revenue decline. Other notable drivers include an increase in deferred revenue balances and remaining performance obligations under contracts with customers, indicating potential future revenue growth. Furthermore, the acquisition of Calypso AI Corp has added new capabilities and enhanced solutions for securing AI inference, which may also contribute to future revenue growth. The net income of a company experienced a significant increase from $166,445 to $180,054 over a certain period. This growth represents an 8.2% rise, which translates to an additional $13,609 in earnings. The improvement in net income is also reflected in the profit margins, with the net income margin increasing from 21.8% to 22%. Furthermore, the gross profit margin saw a slight improvement from 81.7% to 82.1%, while the operating profit margin remained relatively stable at 26.1%. These changes indicate a positive trend in the company's financial performance. The company is indeed generating positive operating cash flow, as evident from the financial data provided. The net cash provided by operating activities has consistently been in the millions of dollars for the past 3 years, with figures ranging from $159,211 in 2025 to $202,782 in 2024. This trend continued into fiscal year 2026, where the company generated a significant amount of positive operating cash flow. Specifically, the first 3 months of 2026 saw an operating cash flow of $159.2 million, indicating a strong start to the year. Furthermore, the overall cash provided by operating activities for 2026 was also $159.2 million, demonstrating a continued positive operating performance that contributes to the company's operating cash flow. Overall, these financial metrics suggest that the company is successfully generating positive operating cash flow, which is a crucial indicator of its financial health and stability. And the analysis of the company's financial data reveals a significant shift in its debt level and interest expenses. On page 11, it is noted that interest expenses decreased from $5,592,000 to $5,945,000, indicating a reduction in costs. However, on page 26, it is reported that interest expenses have increased significantly. Furthermore, the cash used in financing activities has also seen a substantial increase, rising from $114.7 million to $293 million on page 27. These contrasting trends suggest that the company's debt level and interest expenses have undergone significant changes, indicating a complex financial situation. The performance of various segments and regions in the recent period has been mixed. On a positive note, EMEA recorded a significant revenue growth of 24.6%, outperforming other regions. Within the Americas, while the United States experienced a modest increase of 1.9%, other countries in this region fared better with an 8.3% growth. In contrast, APAC was the only segment to report a decline in revenue, with a decrease of 0.7%. This underperformance stands out as a notable exception among the regions analyzed. Overall, these results highlight the varying levels of success across different markets and geographies. Management is optimistic about the company's future outlook, citing customer acceptance rates as indicators of emerging trends. This suggests that the company is poised for growth in key markets. In addition to organic growth, management is open to exploring strategic acquisitions or investments that can enhance the company's offerings and competitiveness. The primary driver of cash flows will continue to be net income from operations, indicating a focus on profitability and efficient use of resources. However, management acknowledges that external factors such as economic and geopolitical conditions may impact customer behavior and overall performance. Despite these potential challenges, the company remains committed to its strategic objectives and is well-positioned for long-term success. The company's financial activities have been focused on share repurchases in recent years. According to the provided information, the company has engaged in specific share buyback transactions for 2025 and 2024. This is further supported by the fact that cash was utilized under the stock repurchase program to purchase outstanding common stock. In conclusion, the evidence clearly indicates that the company has indeed bought back shares, rather than paying dividends to its shareholders. The company's use of cash to fund these share buybacks demonstrates a strategic decision to invest in its own equity, potentially benefiting from increased ownership and reduced share count. There are valid concerns about inventory buildup and supply chain disruption in the company's operations. The issue of inventory buildup is evident in the contractual obligations to purchase large quantities of component inventory over a 4-year term with one supplier, as well as the requirement to purchase from a primary contract manufacturer based on annual build forecasts. This situation raises concerns about potential stockpiling and waste if demand does not meet expectations. Furthermore, it may limit flexibility in responding to changes in market conditions or unexpected disruptions in supply. Supply chain disruption is also a concern due to global supply chain constraints and risks related to shortages that may impact sourcing of components used within products. The contractual obligation to purchase from a primary contract manufacturer based on annual build forecasts further exacerbates this risk, as it creates a rigid and inflexible relationship with suppliers. Overall, these concerns highlight the need for careful management of inventory levels and supply chain relationships to mitigate potential risks and ensure business continuity. That concludes the financial summary for F5 Inc. Feel free to comment below, and I will be happy to answer them when possible.